to get started here, and then other people can join us as we get going. I'm Todd Blickenstaff, the president and program director for the Portland, Oregon PDX chapter of AAII, and co-host of the events that we do for the Income and Cash Flow SIG group meetings like today. I'm joined by John Wong, our able webmaster, and also Gilbert Ho, co-presenter today. And so want to let people know that we've resumed our meetings on the third Thursday of each month, and so we're doing some teaming with other AAI chapters here for a few months, and we're back to doing our regular presentations, hosting these events. Doesn't mean we won't team in the future, but we wanted to get back in the groove of doing these meetings and focusing on the income and cash flow topics. That is the reason for our SIG specialization, special interest group presentation specialization. And so those next meetings are scheduled for Thursday, July 18th, and Thursday, August 15th, both starting at 4 p.m. Pacific Coast time. And we normally go about an hour and a half. We cap the meetings around an hour and a half. And so that's our schedule. We're working on additional topics for those meetings. And so when those get finalized, and the speakers will let you know. We're speaking today, myself and Gilbert Ho. And one of the things I did want to mention on our income and cash flow SIG, which you website, which you can access through the AAI community directory, is that we also have some articles that we've been listing that are pertinent to our subject matter. And appreciate the exchange of ideas, because we've been getting some comments on those. So continue to watch for those under the discussion section of our income and cash flow SIG group meeting. And because when we have topics that we think are timely, or see articles that we think will be of particular interest to our group members, we'll continue to post them and encourage you folks to offer comments on whatever we post, agree, disagree, what have you. We just trying to generate meaningful discussion along those topics. The most recent ones we posted were regarding inflation and also interest rates, and how that's affecting cash flow, particularly for retirees. So, so having said that, what I'd like to do now is we're going to start out the presentation today by turning the microphone over to Gilbert Ho, who's going to present a presentation he does for ourselves and also for the Silicon Valley chapter every month, and to talk about the outlook for the economy and the markets. And so I'd like to again turn the microphone over to Gilbert, and
Cool.
Take it away, Gilbert.
Thanks, Todd. We're going to talk about economy, the market, and the investment. I'm trying to use the font to hint the amount of contents. As you can see, most of it probably talk about economy. Here's the disclaimer. Everything in here is educational and entertainment purpose only. I do all this not only for everybody, but also started for myself, because I am just tired of the noise from the media, and I want to see the data myself with my own eyes and do my own interpretation. So that's probably is what I'm coming from. Also, I want to mention at the bottom of the page where there is no physical laws to govern the economics and markets. So anything we see here is just a probability, and nobody knows what the future is. Okay, so I started out with a mystery chart, and here it is. So a hint of this is, if you count the dots, the last 12 ones are pretty much on the similar level. And the $64,000 question is, which way next? And hopefully everybody has figured out this is actually CPI. So
Consumer Price Index, right?
Yes. Is it your guess of the next move is as good as mine? All right. So the current first thing very important to business is interest rate. And so I have 4 charts here doing clockwise, starting from top left. That is showing the yield inversion. And that has been going on since 2022, I believe. And if we look at the past, which I don't have, if you zoom out and look at the whole history that we have, many times the recession actually starts after this inversion disinverted. So usually that's because the Fed realized they tied it too much, too high and too low. So now people say higher for longer, and that's one of the risks. So we shall see. On the top right, that shows the current Fed funds rate and 2-year Treasury. There has been talking about 2-year Treasury actually reflect where market thinks the Fed fund rate should be. So you can see that it's hovering around 4.8 right now versus the 5.3. So we have about a half point difference here, or 50 basis point, as they say. There definitely is room for cut.
Difference between what, Gilbert?
Difference between the 2-year Treasury and the effective fund rate, Fed fund rates.
Okay.
Yeah.
So going out 2 years versus short-term interest rates. Okay.
Yeah. So if you look at the lower right, we have 2 data series. One is the balance sheet, the Fed balance sheet, which is the purple one. And you can see they're driving it down. It's called quantitative tightening, right? They're reducing it. And so for the last 12 months, they were reducing it by 95 billion per month. And they announced last meeting that starting June 1st, which is this month, they're going to reduce that reduction. So negative is a positive. So this is good for liquidity, I suppose. And as of beginning of June, they cut it down by 18%, around 18%, but they targeted 24. So they weren't meeting their own target, but they're slowing it down anyway. And if you just look at the scale, the balance sheet actually compared to what was 2020 versus the high in 2022, and now they reduced about 40% actually of that increase. So I also showed the M2 money supply, as some people say, money supply drives inflation. Now, if you are in that school of thoughts, then you'll see that you would say inflation is not going to come down soon because the M2 is now flattening or slightly up. So that's another piece of data. Fed has 2 mandated tasks, right? One is maintaining employment. The other one is maintaining inflation. So job opening data is very important in my view because that tells you what the job market looks like. And the small diagram in here shows that number of unemployed person per job opening, and we are below 1, which means for every job opening, we don't have 1 person to fill it. We have fractional person. So that definitely means that there's more jobs than people. The rest of the chart is also very informative. If you look at the purple line, that's the openings that's out there, and you look at that percentage. Even though it's continuing going down, which is what the Fed wants, then it is slowing and it's going back to normal. Same can be said for the green and the red, which is the hires and the separations. Hire means, of course, new hire. Separations is a sum of layoff, quits, this and that, for any reason. So I always say that as long as hiring percentage is higher than the separations, the job market is good. On quits, which is a orange line, you can see that people usually quit to go to other jobs, and it's now normalizing back to all the way back to the last few years. So job market is definitely normalizing, which is what the Fed wants. More information on employment. Again, clockwise, top left says initial claim. Although you see a trend of last few months of going up, if you zoom out, this is really extremely low. So there's no alarm here. On the top right, if you look at the unemployment rate, again, it's very low historically. And the labor participation rate is almost back to where it used to be in 2015, 2016. So again, just says like job market is normalizing. And the lower right, the key line here, key data series here is I take the average hourly earnings and time that with the average hourly works. So that's sort of like saying average weekly earnings. And then this is purple line is actually annual growth rate. So you can see that we are still a little bit high, but we come down from the extreme in 2020 and 2021. And the orange line shows the inflation rate, and the green line shows the total employment. So everything's normalizing here, which is important for Fed to decide the rate. Okay,
Gilbert,
yeah.
The labor participation rate was affected pretty significantly by COVID, wasn't it? The pandemic period.
Yeah, and so there were at least two factors that people were talking about. One is pandemic. The other one is because pandemic, a lot of people retired, and so we lost a lot of labor supply, and so that's why Chairman Powell always talk about this every time he has a press conference.
Mm-hmm.
Now, so U.S. dollar, if you look at this 25-year chart, you can see that we are on the upper end. And in my view, that's good to fighting inflation because you can buy more stuff from other people, from other countries cheaply. Commodity futures may give you a hint of what the inflations look like. So,
Gilbert, can I stop you for just a second?
Right.
Because on the U.S. dollar, we've had some pretty significant news here recently on that, in that we've got the Chinese have been, CCP have been big sellers of U.S. Treasuries. And then there's been movement afoot for others to look at alternative currencies to the U.S. dollar. And I think, I don't have the specifics all down, but I believe that the Saudis say that they're going to deal in oil and not just U.S. dollars, but other currencies. So those are
right, but
that potentially is big dampers on the dollar.
I take the other side. I think those are just noise from the media. If you look at the second to the last bullet in 2022, there's almost 60% of all foreign banks' reserve are still, denominated in U.S. dollar. Of course, that's lower, but I think a few years ago, everybody was talking about RMB is going to be the new dollar, and look what happened then. Now, and so I think the market this dollar index, which represent the market view, and I trust market view. So if the market says we're strong, we are strong. So
yeah, good point.
yeah.
It'd be interesting to see.
I think.
Oh, go ahead.
I'm sorry. It's a simple thing. Is like which other countries, money you want to hold. Personally, I wouldn't want to hold anything other than dollar, right? So that's my 2 cents.
Yeah, thank you.
Sure. Thanks for the input. So on the commodity side, I think this was done before on Tuesday, and today the oil, the crude was going up, and I think gold is going up too. I don't know how much impact that will be to the CPI later, but the trend is it seems like we are still just hovering. We have oil goes up, we have copper comes down, we have lumber stay the same, live cattle goes up a little bit, corn stay the same. So it's a mixed picture on the judging from the commodity futures. Now, one of the things people are looking for to help reduce lower inflation is the rents, the trend of the rents. So personally, I look at these things, and since I live in San Jose, so the lower half of the slide shows the data that I got from this place called apartmentlist.com. And if you look at the lower left, you can see that since 2019, there's only 1 year that annual rent growth was negative. That was 2020, which was minus 13%. Every other year it's plus. And so far this year, we have been up almost 5% here. And if you look at the lower right graph here, you can see that the rent growth rate year over year per month is very seasonal. You always get the highest in the summer, and you always go lowest in December. That makes sense, right? So now, given that we're entering summer, I think you're going to see more rent increase. But how fast that get reflected into CPI is anybody's guess, in my view. And top graph here shows that taking the rent from the CPI, the rent component, you can see that it is coming down, right? And so hopefully that continues. I also showed
Is San Jose a particularly strong town? I notice the rate is materially higher in terms of rent growth versus California overall, which is known for having significant outmigration, as well as the U.S. average. Is that a really strong area, San Jose?
Yeah, I think this apartment list actually rank Humpty Dumpty number of cities, and San Jose's ranking goes up and down all the time. Like in COVID time, I think nobody wants to live in an apartment in San Jose, so that was cheap. That's 2020, and but now it's coming back. So this also reflects the economy, maybe we can try to get information for other places like Portland or other places. But what I was trying to say was when I look at the long-term data on rental vacancy rate, we can see that generally the lowest is about 5% and highest is about 11%. So we are right now at the low end of it. So if a supply continue to increase and vacancy rate continue to increase, that would help the rents, the lower rents. And actually in San Jose, I already start seeing newspaper article that's talking about because they built a lot of apartments around here and in the last few years. So the supply is increasing and there's a pressure to lower the rents. But
Thank you for that
yeah.
explanation. By the way, I should mention if anybody has any questions during Gilbert's presentation or mine later, feel free to enter them in the Q&A section at the bottom of the screen, not the chat, but the Q&A section, and then we'd be happy to respond to those questions following the presentation. So,
yep.
Go ahead, Gilbert. Please.
Okay, so now the inflation, right? So again, the top half, the top left, the main thing is the producer price index and the import price. These are input to the inflation. And so we can see that the producer price, which is the purple line, was coming down and now stabilizing and a little bit higher. And then import price, because we import a lot. So that's very important. And that was negative before, and now it's positive. But, if you look at the past history, it goes up and down. And then there's the export price index. Now, on the top right, there are two sets of two numbers, right? So with inflation, you have the consumer price index, and then you have this personal consumption expenditures, which this pair is what Fed actually use, and their target is targeting the core of PCE, which is the thick red line here, right? So for 2%, right now we are at about 2.8, I think, so, or 2.7. So that's what they wanted to see going down. However, CPI does influence PCE because they're mostly looking at the same data, just how they calculate is different. So hopefully this one continues. I think last month, why is market so bullish these weeks, this last few weeks? Because the last CPI was a surprise on the downside. And so, the next month, which is the release for CPI next month, will be July 12th. And we should see what happens then. The lower half of the slides shows the Eurozone inflation rate and China inflation. And you can see Europe, their central bank start cutting because they are at about 2 or 2.5. And for China, the winter they were deflation, and now they are back to inflation. So that's what happened around the world. Here is a chart. I'm not sure it's very significant, but the retail sales seems to be focused. Markets seem to be focusing on that, and it may hint about the economy. The consumer is the biggest thing in the economy. So the purple line here is year-over-year retail sales growth rate, and you can see that we are positive, which is good, and but not too positive. That's another positive. And the orange line is the consumer sentiment from University of Michigan. There's another consumer sentiment from Conference Board, but I use this one because I think this one goes back a long time. And in the past 2 recessions, you can see that it actually trended down way before the recession. So when it went down to 2020 for the COVID, nobody's surprised. But there were a lot of prediction about recession from this indicator and other indicators that 2022 is going to be a bad one, but we survived. So the lower right one shows the business sales and the inventory to sales ratio. We can see that the sales growth rate is just about neutral. It's 0. So I think that just means it's not too hot or not too cold. And the lower left, you can see the loan total loan credit growth rate, and no surprise with the high rate, we are having a relatively low growth rate on the amount of loans issued by bank. All right, so the the growth of the economy is also important to Fed. So some of the numbers here help us understand that. The top half of the slides shows the two indicators from ISM, and the ISM manufacturing PMI was very famous before, because anytime it's below the red line, which is 50, that means we are heading into recession, and well, didn't happen this time. But then people say, okay, because service is now more important, and service has never gone down much other than a little dip earlier. Chairman Powell does mention about this this particular series in the lower left here, which is called Real Final Sales to Private Domestic Purchasers. And I have his quote here. And from the year-over-year growth rate here, you can see we're about normal. So the economy is not too hot, too cold. On the lower right is the Atlantic Fed's GDP estimate for the second quarter. You can see that is anticipating around 3%. And that's, you know, the first quarter, it was 2.88 officially. So we're pretty high, and anything above 2 is the growth is on the growing side, above normal. I guess people say 2% is the normal. So that just means the economy is still growing, which is good. And it's not going too fast from other data, which is also good. Finally, the leading economic indicator has been very reliable in predicting recessions in the past. In the past, meaning before 2020, and even including 2020, even though it reacted a little bit slowly because that was a huge crash, the COVID. That was okay, but the recent issue is it predicted 2022, 2023 is going to be recession, and now it just reverted itself, and there was no recession. So this is the first time it failed dramatically. But the next release is tomorrow, so we will see what they say. Another very reliable recession leading indicator is this anxious index from Philadelphia Fed. And basically, they survey all the what they call professional forecasters. And based on that, they derive this probability of the recession in next quarter. And you can see that because it's predicting next quarter, usually you are already in recession when they when it goes up. And again, if for 2023, all these professionals failed. They predict recession and it didn't happen. Now, this is another very reliable indicator of coming recessions, because the Fed actually, I believe every quarter, they survey the big banks, and they survey the bank loan officers. So that's what's called senior loan officer. I guess they don't survey juniors ones. But they get a sentiment of these loan officers as to their lending policy, and their lending policy usually hint about economic activities in the future. And so I'll just mention on the top left is the loan officers tightening standard of CNI loans. When you tighten standard, that means you don't want to loan people money. That means you worry about the economy. And in the past, in the 2020, 2008, 2000, this thing started in 1990. They are all this indicator is very reliable. That's why a lot of people say, okay, 2023 is going to be a recession. And like I said, it never happened. The left middle is the loan officers increase their spread. And they increase the spread because they think loaning money is risky. And again, it predict past recessions. And on the right-hand side, it's the same thing, but for consumer loans. And so, all this is saying is it didn't work this time, but maybe they'll work better next time. So FDIC every quarter release some data, and if you worry about your bank deposit, this is something you want to watch for. And there are 6 chart here. Let me go through it. Top clockwise, top left. So first is the quarterly credit loss provision. So you would think they start to increase loss provision when they think they're going to lose money, which means the economy is bad, which means people default. And you can see the positive increase in 2008, 2009, and in 2020, and interestingly, in these following years. So they're very careful, and it's a good thing when they're careful. The middle chart, the top middle, it shows the loan balance. That means how much money they loan out. And if you look at the 12 months growth rate, you can see that they are decreasing lending, which is not good because that slows down the economy. And that's probably because the interest rate too high, people don't want to borrow money if they can. On the top right is the net charge-off rate. I believe that's like they wrote off their loss. And you can see that the non-current means people didn't pay when they should. And the blue line says net charge-off. That means the bank gave up and wrote it off the loss. And you can see that the line is tilting up, and that's probably explaining why they're increasing their loan loss provisions. The very interesting thing on the lower left is the unrealized gain or loss on investment security, and this is a hot topic in last March when Silicon Valley Bank went cuckoo, because banks are sitting on huge unrealized losses. Some of them, they said they're going to hold until maturity, which means they're holding 2% treasury for a long time, which means they're losing money. And the light blue says they can sell these losing securities, but that just means they're going to have a loss.
And Gilbert, can I stop you for a second? And so you're talking about here, you're talking about actual assets, financial assets on the books of the banks, not loans. So
no.
So these are all investment securities in this particular chart.
Right. These are actually the investment security means the bank is holding these treasuries that they're losing money. The lower middle is the number of asset banks on the problem bank list. There's a problem bank list, and here it shows you the number and their assets, and you can see the number of banks in trouble are relatively low, and the assets they have are not that much. That didn't increase that much. The lower right chart is what it woke me up. That says deposit insured fund, which means the FDIC only have 1% of all the deposits that they can use. So if you really have a run for the bank, they can't stop it. All right.
Well, it was really a surprise, wasn't it? Because when the markets were surprised and the regulators apparently were surprised by those two banks going out of business in a relatively short period of time, or have liquidity constraints because it was it seemed to be an asset liability mismatch. Because what happened is they had a lot of securities invested longer term that took a major price hit when interest rates rose. And then at the same time, there were investors that were concerned about that, and they wanted to pull their funds, and there weren't enough short-term assets that they could provide to their customers. So it was a liquidity squeeze based on poor asset liability matching long-term investments that took a major price hit, and they didn't have enough short-term securities to provide for the outflows from the withdrawals from the customers, which I thought and still think was incredibly stupid on their part. That's a basic tenet of banking, is asset liability matching. Would you agree with that, Gilbert? And tell me if you
Oh yeah,
I'm
yeah.
missing something. Yeah,
I totally agree. I think all these banks are managed by professionals, right? And Fed has been saying they're gonna raise the rate. They announced it months, and these guys are just sitting on these low rate and not doing anything. I think it's a human psychology, right? Once you lose money, you don't want to admit you lose money, and you're just going into the hole deeper and deeper. And that's why if you look at the lower left, that chart just scares you. It's a calm on the surface, right? So, however, I think after the Silicon Valley Bank thing, we know what's going to happen next time, right? The Federal Reserve and the FDIC just going to come out and say, I don't care how much money you have in here, we guarantee you get it back, even if we have to print money. So you're not going to lose money with the bank anymore. That's the lesson I learned.
I hope you're right. Yeah.
Yeah, cross my fingers. This is just a bigger picture of the delinquency rate. Again, these are quarterly numbers. And the top half, you can see that's for on the commercial, the credit card and the consumer loans, right? So they tick up like we saw before. And the lower are the mortgages, the commercial real estate loans, and the business loans. And 2 out of 3 are okay. We can always, everybody can guess that commercial real estate is the one that shows a little bit tick up. But then again, this is Q1, right? And we don't know how bad it's going to get in the next few quarters. New York Fed also does a quarterly household debt survey, and again, the top left shows that the composition of all the household debts, and 70% of it is mortgage. So if a lot of people got the 30-year low rate, they're just sitting on it and not doing anything. That's basically any kind of interest rate manipulation you do is only going to impact the rest of the 30%. So the interest rate manipulation power has been reduced. On the top right is total balance by delinquency, right? So if you look at the total, all the delinquencies, the 30 days, the 60 days, the 90 days, 120 days, and the trend is slowly going up, but we are just at 2006 level. So it is not too bad. The lower right shows just the 30-day delinquency. And the 2 lines that you catch eyes are the auto loans, the green one, and the credit card, the blue ones. Everybody else seems to be okay. I was surprised. The mortgage delinquency is also going up slightly. On the lower left, you see the number of consumers with new foreclosures and bankruptcies, and again, we're at historically low levels. So that just says the household debt is in good shape. One of the reasons
that mortgage rates haven't delinquencies haven't risen significantly. It's all more shorter term. Credit card and auto loan are the significant trends here in terms of increasing debt.
Yep.
Delinquency.
So one of the reasons Chairman Powell said they're going to lower rate is if there is financial crisis. So there are 4 indicators that I collect here to show the their numbers. I apologize, I didn't update so you can see by the date, but I did update the numbers, and all 4 of them are negative. So there is no financial system, no financial stress, no sign of stress. So they're not going to cut rate for this reason. All right, so finally get to the last meeting we have here, and so they kept the rate the same. They reduced the QT amount on the tightening amount, and they come up with a summary of economic projections, which I showed on the lower half of the screen. Now, the SEP, as they call it, is only the survey of the 19 members of the FOMC. So, and their staff, I guess. So what they said was, so if you look at the 2024 GDP estimate, last month they say 2.1, this month they say 2.1. And we are at 2.88, so we're higher than their expectations. So in their view, okay, we're growing. Unemployment rate, they say 4.0, we are at 4.0, no change. The inflation, their PCE target, they raised it actually. If you compare last meeting with this meeting, and if you look at the core PCE, which is the 2% they're targeting, they're raising it to 2.8, and we are at 2.75. I don't know if this is a hint that they can now say, oh, okay, the data shows we can lower it, but we shall see. Based on what Chairman Powell keep on saying, they don't have confidence. They probably need 3 months of continuing lowering inflation rate. And so if you take out the calendar and you look at this, most likely, if they're going to cut rate, it's going to be the December meeting. And if you look at the Fed fund rate, they used to say we are at 5.33, and last time in March they say 4.6, which gives us 3 cut. This month they say 5.1, which gives us 1 cut. And on the lower right, that shows you the FOMC meeting and FOMC members survey and what they think the rate is going to be at the end of the year. And the good news is it's for the next 2-3 years, they're looking at it continue to going down. It looks like ending at 3%-ish. Okay,
well,
so
it's
those
interesting also, you know, I think, remember last fall, I think, you know, the Fed had said, oh, we expect as many as 7 rate reductions next year. And then it's steadily decreased since then. I think the most recent thing I saw that come out of the Fed was Neil Kashkari. I think there's a New England Fed representative. And he said, I think, you know, 1 rate cut is probably all we're seeing, and that's in December. And I mean, he's not the Fed chair, but he's free to speak. And actually, I've followed his career. He's a very, very bright guy. So interesting what a big dramatic swing it's been in terms of potential rate reductions. And that was assuming, I guess, 725 basis point, you know, quarter percentage point rate cuts were likely in 2024 based on 2023 projections. Well, that's a dramatic change.
That's no surprise, right? Because if you believe they are following the data, and like my first mystery chart shows you, the last 12 months we're going nowhere in inflation. So that high hope from the previous sharp drop was damped down. So you know, if the inflation rate continues to go down, and I think they have 4 meetings left: July, September, November, and December. Nobody expect anything in July, and they usually give you some notice they're going to do it. So if they come out in July and say they're going to do it in September, that's one possibility, but the data doesn't support that. And then
it's also an election year, and they probably
so they're not going to do the November because that was 2 or 3 days before the vote. So they probably not going to do anything, and then so the only possibility is December. But that's
right. They say they follow the data. Good point.
I think December is good. That means the year-end rally, Santa Claus rally. So okay, so those were economy, and now we'll look at about the market. And one of the things it's interesting is to look at margin debt. Margin debt actually is not is a lagger, not a leader. But it's good to know that the price is going above is making new highs, and the debt is making new highs. That means the market is in. People, the participants are doing it. There are some bullish signs here I collected. On the right-hand side, the case for SP 6000. Well, some people point out that we are at 55 right now, so going to 6,000 is not a big deal. You're definitely going to get there this year or next year, or many years later. On the left-hand side, there is there are two charts that's interesting. One is talking about buyback, and if you buyback is reduced supply, which is indirectly increase the price. And that is the trend is up. And then Morgan Stanley leading earnings indicator sort of trying to predict that the earning growth is going to be there, and therefore either PE expansion or price is going to go up. So those are good signs. The corporate profit, I pulled this out and to show that the history is too long, so I cut it into two charts. One is from 70s to 2000 on the top, and then from 2000 to 2024 on the bottom. What I'm trying to say here is, what do you want to watch for? These are quarterly data. So when you see the trend, you have time to react. And what I'm trying to say is the typical divergence. In other words, when corporate profit is falling and the price is going up, it generally don't end well. And so that happened in 98 to 2000. That happened in 2006 to 2008. We don't have that right now, knock on wood. So keep an eye on this one for market direction. All right, so we talk about US dollar, so we can look at the world stock market. I selectively picked a few ETF, and the interesting thing is US is in the top, at the top for sure. And this thing started July 2019. Right now the number 2 is India, and third group are Japan and Europe, and then at the bottom is China, Southeast Asia, and Latin America. Of course, some people say, well, the valuation, which is the other way around, right? So, as we have the highest PE ratio, and so if you're a value investor, you probably go for the PE, low PE ones. But that's a judgment call. This is another random asset classes I pulled out just to take a look, and I was surprised to see that gold, giving its volatility, it seems to be doing okay in the last 20 years. In the last 20 years, it was a 5-bagger, and the TLT, which represent 20+ year long-term treasuries, double in 20 years. But if you were holding it in the beginning in the early 2020s, then you lost half of that. So this is interesting to look, but just for fun. Now, we're an income group, so I look at the dividend stocks and small stocks, but I choose the equal weight ETF to show them. So there's there are three ETFs. The RSP is the equal weight for Standard Poor 500. The Noble is the dividend stock, and then the EWI is the small equal weight. And this small, I took Standard Poor 600 rather than the Russell 2000. And so,
can you tell us which color is which? I'm having trouble seeing.
Sorry, the legend is over here. So the blue is RSP, the green is Noble, and red is EWI. So what surprised me was Noble, which is a dividend stock, which is the green, isn't doing that bad compared to equal weight Standard Poor. But really surprised me is the red, which is the equal weight Standard Poor 600 small stock index. It's very volatile, so it suffered huge loss by the end of 2022, right? So in 2022, it suffered a huge loss, but it made a huge gain since. You wouldn't notice that if you're looking at capital weighted. So just some, I don't know if there's any insight in here, but now there's also after 2022, people are worried about losing money. So there are a class of ETF called defined protection or called buffered. So basically use option to protect the downside, but that protection come with a cost on the upside. So they actually usually cap the top side. And I noticed that recently there are new ETFs that says that we will protect you 100%. And so what they really meant was and these are all 12 months or 24 months ETF. In other words, they say if you buy now and a year later or two years later when the term's up, we guarantee you never lose money. Not in between, but just between the starting point and end point. So I plot the one which has a longer history. Again, legend is on the top left. So blue is SPY, green is TJUL, that's July. They started in 2023 July, so that's where this chart starts. And you can see that they lost less while Standard Poor, and when it was SPY lose more, but SPY gain much more than what they gain. So I guess you got to be brave if you want to invest in stocks. I found an article that's dated August 2022, and it was talking about high yield ETF for retirement portfolios, and he lists 5 of them. Now, at the time when you look at this, JEPI, which I think most people know, looks promising, right? And they give you the TTM is 12 months, trading 12 months yield dividend, so almost 10%. That looks very attractive. They all look pretty attractive. There are 3 of them more than 9%. And so 2 years later, or a year and a half, or whichever, I look at it now, and these data series are dividend adjusted. So it's a fair comparison. And the legend again is top left. You can see that JEPI, the green, gave you a CAGR about 6%, but QDPL gives you about 9% CAGR, and that's about the same as SPY. So if you're getting dividend growth, then that's not bad. However, you should investigate more if you decided to invest in it. I'm not recommending anything here. I don't own any of those. But that's just to, I guess, for entertainment to see these charts. Also, finally, I think I have a friend who asked me to look into this yield max ETFs. So this is apparently a somewhat newer ETF, I think the first one they started is in 2022. So they are active managed ETF. Most of these are targeting a single stock, and they use option to create synthetic long positions, so they don't own the stock. And the potential monthly income, they give you monthly income, and that's usually come from the selling short-term options. So, you know, a lot of people saying do options to get income. Okay, so these professionals are actively managing these ETFs, so we can get a sense of how is this actually work? Does it work good? Well, you can read the details in here. I won't, you know, go through them here, but if you look at all their offerings, they have more than 24 of these. And if you look at the reference asset, that's the single stock. They have all the Mag 7, and they have a combined Mag 7, and then they have C3AI, Coinbase, Master, Netflix, and Disney, and Exxon, JP Morgan, AMD, PayPal, etc. And so I was shocked to see this huge number in terms of distribution rate. And then I look at the 30-day SEC yield. I said, why is this so different? So I look into distribution rate. So the distribution rate is calculated by multiplying 12 months, this month times 12 and divided by the ATS most recent NAV. And so it is important to note that representing a single distribution from ETF, and does not represent a total return. And as I was searching, I found 2 articles. So first article is most recent. This one, you know, his data shows June 17, which is 2-3 days ago. So the analysis from this gentleman is, he said, who is this for, right? So if you want a high dividend income and you understand that you're getting your capital handed back to you, then this is for you. And, you know, you also receive a small amount of call option income in return. So basically, you're saying if you think a stock, because these options are based on a single stock, if you think the stock is low volatility, maybe good. And then he lists the risk, right? It's a single stock risk, a volatility risk, and taxes, and then again, you may end up not getting what you want. And he took an example of Tesla. Tesla is one of the first ETFs this company provided. So starting in late 2022, you can see that the Tesla stock total return versus this ETF total return, and the ETF is not doing that well. So for a stock that went up more than 40% and then come back even, you know, your total return is negative. So be careful with these. Again, I think
Tesla, the stock doesn't pay a dividend, does it?
Tesla doesn't pay a dividend.
Yeah, that's what I thought. So these are kind of,
so they use option to generate income for you.
Right.
But I think the key thing here is when you look at this chart and you say, well, this doesn't make sense. But I think one of the things that wasn't mentioned is single stock is a risk, but it's also where your revenue comes from. Because if you look at the next article, which is talking about NVIDIA, you can see that, again, I have 3 lines. Blue is SPY, green is NVIDIA stock, and red is the option. And the option ETF give you 3x. Of course, the stock itself gives you 5x, but that's much better than your SPY. Right? So if you pick the right stock, if you pick this NVIDIA on fire saying you're doing well, but and you know, if you don't have the heart for the stock itself, you can try the ETF. But again, the three questions, right? Whether you believe this is a strong stock, and then you need to believe in the outlook. Next, if you are bullish on the shares, do you really wanted to trade away your upside? Right? You can see the difference. And finally, tax liability. So the two articles I have on this is interesting. And I heard a lot of people DIY using options to generate income. I don't know if you compare to the professionals, how much better you'll be doing. So finally, a speculation. So what is happening here is the Ken Fisher, I think most people know him, or has been receiving his propaganda, and has been saying that the stock market behavior in 2024 election cycle is like that of 1968. I wasn't around here in 1968, but I think that's the year when Nixon got elected. So I think he implied that the similarity there. And I have plotted the two charts. One is the green, the blue is SP 500 from 65 to 70. And the green is SPY from 21 to now. So you can see that there was a dip, and then there's a recovery. In the 1968 case, right after a month after election, that was the top. We are still shooting up, so we don't know where we're gonna do. But it's interesting because then in 1968 we have Nifty 50. That was narrow leadership by those days standard, and then also in 68, starting on 57, Fairchild Semiconductor was founded in 1957, famously. And we now have AI boom, so sort of resemblance to the semiconductor, which totally influenced the technology. So something, a speculation here. Finally, the last slide, which is seasonality. I picked some of the best years, election years, performance, and you can see that all these end well. They are all at least 10% by year end. We are sitting here. At this point, we are the highest or above the same as highest in the history. And where we're going to end up with is anybody's guess. And that's all I have. I'd be happy to answer any questions.
Well, thank you, Gilbert. We had one written question, but we're going to defer till the end of the next presentation. So why don't we move to that in the interest of time?
Okay, so I
we
will
have a hard
sharing.
stop at 5:30.
Okay,
so,
I will stop sharing and you can take over.
Okay. Yeah, I think this is it. Okay, the second part of our presentation here is basically it's kind of part two. It's a resumption of higher for longer interest rates because we have, as we mentioned in the previous presentation, that we're looking higher for longer, less probability of rate cuts this year, or at least reduced rate cuts, and so we're going to continue to be in the kind of environment that we've been in prior years for the last couple of years here. And so going over the history of where we are, it's important to remember that we've had a lot of volatility in the bond market over the last few years, uncharacteristically significant big volatility with the interest rate trend increased. I mean, you can see going back to April of '94 on the far left-hand side of this chart. And then if you move to the right here, all of a sudden rates just sprung up dramatically in 2022. I think everyone's aware of this trend, but it is pretty significant to look at it. And I saw a presentation recently that talked about asset allocation and returns, and basically said that I think it was a portfolio that was 60% in bonds and 40% in equities compared to an all equity portfolio. And the all equity portfolio is done, these were 3-year numbers. I think it was about a month ago, so I think it was May through May, and basically said that, you know, you had nice positive rates of return from the equity market, but because of the sell-off in bonds 2022, basically, if you had a 60% bond, 40% equity portfolio, you had a 0 average rate of return over that time period. The loss in bonds more than offset the gain you had in equities. So that's a pretty significant event for that to happen. And but since then, of course, now we have interest rates at a higher level. Doesn't mean they're necessarily going higher from here, but that volatility caused people that had more conservative allocated portfolios with overweightings in bonds to take a price hit there. And I'm going to move on to the next slide. But bonds are more fairly balanced. These charts are not all current. Some of these were earlier this year because I think they still apply. But what it says is with rates moving higher, now you're getting a fair amount rate of return from bonds. And it's a more balanced break-even ratio that we really hadn't seen in the bond market because interest rates have been so low for so long, going back to 2009, mentioned here, which was the bottom of the market in the Great Recession. So at the point now, you have if you saw an increase in interest rates from here with yields where they are, you're going to not take much of a negative. In fact, you really wouldn't lose much of anything if rates rise a full percentage point from here. And that's because the current rates of return on bonds are much more attractive because rates have moved up so significantly. So that's a major move, and bonds are no longer the poor investment that they were going back through until 2022 when they started to increase for the first time in decades. So that's pretty significant. And so it's important to recognize, even if you're a total equity portfolio person and you don't want to own bonds, haven't owned bonds, important to recognize that bonds are providing a healthy rate of return now, or I should say an average rate of return, because what the Fed has really done is normalize interest rates to the levels where they were during the 90s and into the early 2000s before rates came down so significantly as a tool to combat recession during the Great Recession, and of course more recently than during the pandemic. So. But it's important to note that the underlying indicators for the bond market, which are really the underlying indicators for the economy that Gilbert just went through, are relatively healthy. I mean, they're pretty good, and the bond market trades off the same type of indicators from a credit quality standpoint that the overall economy does. So what we've seen here is interest rate spreads are relatively narrow. They haven't widened. If the bond market was worried about a recession, we would see interest rates on corporate bonds significantly higher than they are relative to Treasury bonds right now, Treasury and agency bonds. But those spreads are relatively narrow. And so that's saying that the bond market doesn't see a recession on the horizon. And that's an important indicator. Now, if we down here, and this chart also shows that spreads are tight, bond and quintile for investment grade and high yield. And but it's also important to note that even though spreads are relatively tight, yields on corporate bonds and high yield bonds and other types of fixed income instruments that are considered relatively risky compared to Treasury bonds and government agency bonds are pretty attractive. So those attractive current yields and yields to maturity to calculate bond returns in the traditional measure are relatively attractive. And it's telling you that the risk reward ratio for bonds is much better than it's been in a long, long time because rates are higher than they've been in 20 years. And that's significant. So from here, even though spreads are tight and people might worry about, oh gosh, our spread's going to widen from here, that could have some negative impact, but it's probably going to be the bond market is telling us that that's going to be more than offset by the attractive yields that we're getting because rates have moved up so significantly from where they were several years ago. And it's hard to fight the Fed. But one of the things that we pointed out earlier, and when Gilbert was showing what's happened with the banking sector and mentioned Silicon Valley Bank, which was one of the two banks that went out of business a couple of years ago, that was because they didn't match their assets and liabilities. They were holding long-term securities, and they had investors that wanted to pull their money out and what the Fed had to do, because the long-term securities took a significant price hit, they had to sell them at losses to provide funding for the deposit withdrawals that investors were demanding. And they got upside down as a result of that because they had too much what we call duration risk in the business, and that too much of their investment portfolio in terms of bonds were positioned on the longer end of the curve, and they take a significant price hit. And that's where I think I showed you guys a chart back in January that showed that's where the losses came from in bonds. If you had longer term bonds, you really got hammered the last couple of years. That's where the losses were, not from interest rate spreads, but because if your average maturities were out there on the yield curve too long, you took a really tough price hit. So and it's saying right now with yield curve inverted in the short term and a relatively unsteep yield curve, you're not rewarded for extending maturities, so why do it? So what this point is making, and I should point this out, this is from a presentation that State Street did, which is a very good investment house. I'm not recommending State Street securities or anything. They just do good analytics, and it's better than anything I could have put together myself. So I'm using some portions of their presentations in this presentation today. So, and they're not the only ones recommending positioning on the short end of the curve to pick up yield. But this is important to point out here. And this little clip, it's messy. It's got my writing on it, but it's from a recent Wall Street Journal article. If you're still sitting in low yielding savings accounts that might be yielding less than a percentage point, and you have the opportunity to position to money market funds that might be yielding as much as 5% or so, it behooves you to do so. And for those of you that want to own securities that are beyond short-term savings, you can position in shorter-term securities beyond money market, in other words, beyond 90-day maturities, and earn pretty attractive yields. But also, if the Fed does lower rates, the markets tend to be anticipatory, and those yields are going to come down on those savings accounts. And they're also going to come down on the bond market maturities, especially in the short end. So if you're going to extend maturities, you'd be wise to do it sooner rather than later. Fed's giving us lots of warning here, as Gilbert pointed out, and we're likely not to see anything probably prior to year end, but the markets start to anticipate that, and that's one of the reasons why yields have started to come down already. They're significantly lower in some areas of the yield curve than they were 3 to 6 months ago. So keep that in mind for how you're positioning your cash. You can lock in some of those yields sooner rather than later before they come down, and they are likely to come down. It's a matter of probably timing, not direction. What the Fed does, their next move in interest rates is likely to be downward, barring any kind of unexpected inflation surprise. So this is saying, here's another point that State Street makes: how to manage reinvestment risk, put some of that money to work now. You don't have to do it all together or all at once. You might use a dollar cost averaging program, move some money out of your short-term savings account and even money market accounts into short to intermediate term bonds and get some higher yields and lock them in for a longer period of time before they disappear. One of the things that mentioned is if you have losses in longer term bonds in a taxable account anyway, take those losses where you can use them to offset gains that you might have elsewhere, perhaps in your equity portion of your portfolio. And that's, of course, most material if you're talking about taxable investment accounts as opposed to tax deferred. But short-term duration bonds are pretty attractive. You can make some adjustments and use some things like convertible bonds, preferred bonds. And we're going to be talking about those asset classes in more detail on future calls for this special interest group, the SIG group. And so be watching forward because we're going to go into much more depth on those type of investments like convertibles and preferreds. Those will be two of the topics we'll be highlighting going forward, among others. So these are just some examples that State Street mentioned that are funds that fit those kind of criteria. And if you can pick up most of the yield that you'll get in the yield curve by just going out, 2 to 5 years. You don't have to extend beyond that to get maturities, and still probably not good risk reward buying longer term bonds, 20 and 30-year bonds, because they still tend to be more volatile. Senior loans is another area on bank balance sheets. Again, we're going to be going in explaining those in more detail on future calls, so I'm not going into much detail here, but that's an area of the bond market that's very recommending. Senior floating rate loans for high quality debt on bank balance sheets are considered attractive investments and can have pretty attractive yields too. Where you can get in the 7, 8, 9% range. High quality investment grade bonds, maturities between 1 and 10 years. That's probably a good maturity structure to go out and get some attractive yields relative to U.S. government bonds and without taking on too much volatility. 10 years and under, you're probably not going to see major price hits if rates rose further, which may not happen, as I mentioned, versus what's going to happen with prices on 20 and 30-year government bonds. It's going to be a different situation. So, and that's so really what we're seeing here is there are advantages in extending maturity beyond. In other words, don't just hopefully not have to sit there in money market or low yielding savings accounts for all of your assets. If you're in low yield bank accounts, I would look at looking for some money market yields that are in the 4 to 5% range, because that's material. I mean, for so long, none of the bank accounts or money market asset accounts were paying anything. So it didn't really make a difference to move your assets around to other types of short-term savings vehicles. But now many of the banks are still paying, low to mid single digits. And that's not, whereas you can pick up 4 to 5%, it's worth repositioning and then figure out, well, how much do I need to have in short-term savings? Can I move out to intermediate term bonds along the lines of some examples that we talked about, and to reposition things to take advantage of that for picking up some yield and locking in yields for longer periods of time. Because keep in mind, those money market accounts, those consist of assets, and bank accounts consist of assets with a maximum maturity of 90 days, which means if there is a change in interest rates and interest rates are reduced, that impact is going to show up very, very quickly in impact in the bond market. And so, whereas if you've got 2 to 5 or 10-year bonds, those take a while to roll off, and you can enjoy higher yields for longer, as long as they're available. it takes an adjustment period for rates to reflect changes in the market. So this is I know running a little bit late. We've got a hard stop at 5:30 today, which is about 5 minutes. And I know that I'm having trouble getting back to my screen where I had that question. John Wong, would you mind reading that question that we had in the Q&A section?
To maximize cash flow and outperform treasury bonds, do you believe buy right ETFs, for example, QYLD, are a good investment tool versus basic index funds like QQQ?
Yes, that's an excellent question. Thank you for that question, whoever submitted it. And yes, that's another instrument. It's an example of on a previous slide where I talked about use hybrid securities. That's an example of a asset that's in the hybrid space where there's an equity component and a bond component, and you can enjoy the return that you can get from that asset. So yeah, we think that makes sense to because they tend to have what's called an equity kicker. That will also be convertible bonds also will be another subject that we'll be featuring in an upcoming meeting, going into depth on those. Yes, those can be high quality investments. They also tend to do pretty well in equity market rallies as well. I mean, for myself, I had some in 2020, and when the market turned after selling off, and I had purchased some relatively recently, they did about as well as my long only equities did for a while. It has to be the right kind of environment, but during strong market rallies, they tend to do pretty well. Plus, they've got an attractive current yield, so it makes sense from that standpoint. So, let's see. I don't mention we're a bit time constrained here. Does anybody else have any questions? And you can ask them live if you want. We can try to answer them before we finish up. So, okay.
I can read you another one, Todd.
Okay, go ahead, John.
What are your thoughts on preferred stocks that yield over 5% as potential investment for fixed income?
I would say also that's an attractive area that we'll also be spotlighting, and preferred stocks do tend to, I mean, it is an equity component, like common stocks, but they tend to have higher yields, and they're further up on the food chain in terms of being secured by the institutions that issue them. So they can be attractive, and there are ETFs in addition to individual preferred stocks. You may want to buy a diversified ETF or mutual fund, and to get that exposure and some broad diversification in the preferred stock space. But yes, we do like preferred stocks. So,
Couple more, Todd.
okay, try to get to those. Go ahead, John.
Okay, do you think New York Community Bank will rebound? Will it take 5+ years? Question mark.
Oh, that's one I'd have to defer to. It's because it's Security Pacific, and we're not going to, officially the same disclaimer that Gilbert showed earlier applies to this presentation. We're not going to make recommendations on specific securities in this forum because this is more educational and not advice driven. So, so I have to apologize for not being able to answer that in more detail. Okay. Did you say? And was there one more
Is this a
question?
good environment for REITs?
Let's see. REITs, that's an area that we like REITs long term, and it's a good substitute for real estate. For those of you that some of you may have rental housing, that type of thing. I know we have some members on the AI board that have exposure there, and it's REITs are a way to be cost effective and broadly diversified in the real estate sector. But one thing I would say is better be specific in what type of REITs you're looking for. Office buildings, for instance, REITs have been hammered because of large vacancies, particularly in metropolitan areas like Portland, Oregon, that have taken big price hits. So REITs in residential and infrastructure long term should have attractive component. Also, data centers, because of the increasing demand all the time for AI exposure, and areas like that. But be very careful with broad REITs that may have significant office space exposure, given the fact that we're probably not close to seeing the bottom in office values. I know in this particular market, Portland, Oregon, we've seen some large reductions in valuation in office and the REITs that own them. So it's been a tough space to be. So REITs is another subject that we're going to be talking about. Another subject I'll just mention is annuities. That's another area that we're going to discuss. So those will be topics for future meetings. So be sure to watch, keep posted to the website, and we'll send out notices for upcoming meetings and corresponding topics for everyone that's a member of the Income and Cash Flow SIG group. So I want to thank everybody for attending today. We are out of time today. And again, appreciate everyone and providing your attention and questions as well. And we'll look forward to speaking with you again on future meetings. Again, thank you very much to our webmaster John Wong for Gilbert Ho and his detailed presentation that he provides, and that's going to be ongoing component of our future meetings as well. So again, I'm Todd Blickenstaff, and for Gilbert Ho and John Wong, thank you very much for your participation in our call today.